76% of active retail traders in the United States rate their own investment knowledge as above average. Sit with that number for a moment. 76%. In a population where 50% is the mathematical ceiling for above-average performance, 76% of participants believe they occupy the winning half. The FINRA Investor Education Foundation documented this in their 2023 survey, and what makes this finding genuinely dangerous is not the vanity it reveals. It is the neurological mechanism it exposes. The same overconfidence bias that causes the underperformance simultaneously prevents the accurate assessment of the underperformance. The trap is self-sealing. Today we are going to examine three investors, Tyler, Greg, and Ryan, who begin at the identical starting point. Same age. Same salary. Same $1,000 per month available to invest. Same 30-year horizon. The only variable is what each of them does with it. And the gap between where they finish will be the most important financial number you encounter this year. The statistical patterns and research findings presented throughout this analysis reflect population-level outcomes across documented datasets. Individual results vary based on specific security selection, execution quality, tax situation, and time period. Nothing in this analysis constitutes personalized investment advice. All investment decisions should be made in consultation with a licensed financial advisor and qualified tax professional. Tyler is a dedicated active day trader. He spends approximately 2,000 hours per year researching positions, monitoring charts, executing trades, and managing his portfolio. He is not casual. He is not undisciplined. He reads earnings reports. He follows technical patterns. He has a system. Greg takes a middle path. He actively manages a diversified portfolio of individual stocks, researching and rotating positions quarterly, spending approximately 330 hours per year on his investments. Ryan does something that Tyler finds genuinely difficult to respect. Ryan sets up an automatic monthly contribution to a low-cost total market index fund, checks his balance 4 times per year, and spends approximately 4 hours annually on his investments. Before we examine where they finish, we need to examine the three forces running against Tyler and Greg every single day, forces that operate silently, continuously, and with mathematical permanence regardless of how skilled, disciplined, or intelligent the trader executing against them happens to be. The first force is what tax researchers call tax drag, and its mechanism is more destructive than most active traders ever calculate precisely. Long-term capital gains, on assets held for more than 1 year, are taxed at 0, 15, or 20% depending on income level. Short-term capital gains, the gains produced by the trades Tyler executes throughout the year, are taxed as ordinary income. For a household earning $75,000 annually, that rate sits at 22% federal before state taxation is applied. Place these two rate structures side by side. The long-term investor holding an index fund with 3% annual portfolio turnover realizes almost no taxable events annually. Tyler, churning his portfolio at the frequency active day trading requires, realizes taxable gains continuously. Now follow what this differential does to the compound growth rate. A portfolio earning 10% annually with gains sheltered from annual taxation compounds at the full 10%. A portfolio earning 10% annually with 30% of gains realized as short-term taxable events at a 22% federal rate compounds at approximately 8.34%. That 1.66% difference does not sound catastrophic in isolation. Track it across 30 years on a $1,000 monthly contribution schedule. The terminal wealth gap produced by the difference between 10% compounding and 8.34% compounding reaches approximately $687,000. Read those words carefully. $687,000, not from bad stock picks, not from a market crash, not from a single disastrous decision. From the silent, continuous, mathematically permanent destruction of the compound growth rate by annual short-term gain taxation. This is not a fee you pay once. It is a permanent reduction in the mathematical base on which every subsequent year of compounding operates. The damage is front-loaded and irreversible. The second force compounds directly on top of the first. Academic research in market microstructure, the formal study of how trading costs accumulate at the transaction level, quantifies the total round-trip trading cost as the sum of three simultaneous components. The bid-ask spread, the difference between the price at which you can buy a security and the price at which you can immediately sell it. For liquid equities, this runs approximately 0.05 to 0.15% per round trip, small per trade, enormous at day trading frequency. Market impact costs, the price movement caused by the trader's own order entering the market. And opportunity cost, the return foregone on capital held as cash during execution windows. A day trader churning their portfolio 20 times annually, a conservative estimate for genuine active day trading, incurs friction costs of approximately 1.5 to 2.5% annually before any tax consideration. Combine this friction cost cascade with the tax drag mechanism and examine what remains of Tyler's gross return. If Tyler earns 10% gross, subtract the 2% friction floor, subtract the 1.66% tax drag, and examine what Tyler actually takes home from his trading activity. The market does not need to beat Tyler. His own trading infrastructure does the job automatically, every year, whether his stock picks are right or wrong. Now examine the statistical landscape Tyler is operating inside, because this is where the foundational assumption of active trading skill confronts its most comprehensive empirical refutation. Researchers Brad Barber, Itsung Lee, Eugene Liu, and Terence Odeen tracked every single day trade executed on the Taiwan Stock Exchange across a 15-year period, the most comprehensive individual trader performance dataset ever assembled. This was not a survey. It was not a sample. It was the complete transaction record of an entire national market across a decade and a half of trading activity. The findings: fewer than 1% of day traders earned consistent profits after accounting for transaction costs. 97% of individuals who day traded for more than 300 days lost money. Not in one bad year. Consistently. Across the full measurement window. Now place these two data points side by side. On the left, the Taiwan retail trader consistent profitability rate, below 1%. On the right, the professional fund manager outperformance rate from S&P Dow Jones Indices SPIVA Scorecard, the most comprehensive active versus passive performance database in existence, over a 20-year horizon. 94.8% of large-cap active fund managers underperform the S&P 500. These are not amateur retail traders. These are professionally credentialed portfolio managers with Bloomberg terminals, analyst teams, proprietary research infrastructure, algorithmic execution, and decades of institutional experience. The gap between the professional failure rate and the retail failure rate is 2.2 percentage points. Tyler does not have a Bloomberg terminal. He has a laptop and a charting application. And the researchers who wanted to verify that the Taiwan finding was not a cultural artifact replicated the study in Brazilian markets. Chaig and colleagues in 2020 found that 97% of individuals who traded actively for more than 300 days in Brazilian equity markets lost money. Different country. Different market. Different regulatory environment. Same mechanism. Same outcome. The neuroscience explains why skill and experience do not close this gap the way traders expect them to. Hirsch Schefrin and Meyer Statman's foundational research on the disposition effect, subsequently confirmed at massive scale by Barber and Odeen's analysis of 66,465 household brokerage accounts, documents that retail investors sell winning positions 1.5 times more frequently than losing positions, despite the fact that winners subsequently outperform losers in the data. Think carefully about what this means operationally. The active trader is systematically selling their best investments and holding their worst, the precise inverse of the optimal strategy, not because of ignorance or laziness, but because of a neurological process operating below conscious awareness. The amygdala's loss-aversion threat response generates greater psychological pain from holding an unrealized loss than equivalent pleasure from holding an unrealized gain. The result, the prefrontal cortex's long-term planning function is overridden at precisely the moments when long-term thinking matters most. Now layer the overconfidence data from the 66,000 account study directly on top of this. The most active trading quintile, the highest frequency traders, earned average annual net returns of 11.4%. The least active quintile, the investors who traded rarely, earned 18.5% annually. A 7.1% annual performance gap between the most active and least active investors in the same dataset. The gap is not a rounding error. It is the systematic, documented cost of overestimating the precision of your own information while underestimating the competence of the counterparty on the other side of your trade, who is frequently an institutional algorithm with superior data, faster execution, and lower transaction costs than you possess. The structural alternative to this cascade of forces operates through four simultaneous advantages that compound multiplicatively rather than additively. The first advantage is cost. The average expense ratio for a broad market index fund runs 0.03 to 0.06% annually. The average actively managed fund charges 0.5 to 1.5%. The total cost of Tyler's active trading, combining platform fees, spread costs, market impact, and tax drag, runs 1.5 to 3% annually. The second advantage is tax efficiency. The Vanguard Total Stock Market Index Fund carries an annual portfolio turnover rate of approximately 3%, generating minimal taxable events. The average actively managed fund turns over 70% of its portfolio annually. A day trader turns over more than 2,000%. The tax efficiency advantage alone is worth the Dalbar behavioral gap in many scenarios. The third advantage is diversification completeness. Ownership of every security in the index simultaneously eliminates single security risk while capturing the aggregate return produced by the entire market. The fourth advantage is behavioral protection. The absence of individual security decisions removes the primary vector through which the disposition effect, overconfidence bias, and panic selling destroy returns. These four advantages do not add. They multiply. Each advantage compounds on the output of the previous one across a 30-year horizon. Now examine where the three investors actually finish. At the 5-year mark, Tyler has accumulated $63,000, Greg $68,000, Ryan $75,000. The gap is present but not alarming. At year 10, Tyler holds $134,000, Greg $154,000, Ryan $192,000. The compound divergence is accelerating. At year 15, Tyler $213,000, Greg $264,000, Ryan $373,000. At year 20, Tyler $302,000, Greg $453,000, Ryan $656,000. At year 25, Tyler $400,000, Greg $620,000, Ryan $1,095,000. At the 30-year mark, Tyler $511,000. Greg $812,000. Ryan $1,778,000. The shaded zone between Tyler and Ryan, $1,267,000, is the measurable, 30-year cost of Tyler's activity. That number belongs on screen. It belongs in every conversation about active trading. It is the answer to the question of what the behavioral gap, the tax drag, and the friction cascade actually cost when they compound simultaneously across a full investment lifetime. But the financial gap is not the most devastating number in Tyler's 30-year accounting. Nobel laureate Gary Becker's human capital theory establishes that time has a measurable economic value equivalent to its highest alternative use. Tyler invested 2,000 hours per year in his trading activity across 30 years, 60,000 total hours. Greg invested approximately 10,000 hours. Ryan invested 120 hours, the equivalent of 3 working weeks spread across 3 decades. Place 3 calendar visualizations side by side, filling proportionally. Tyler's calendar is saturated across 30 years. Ryan's calendar has 3 weeks highlighted across the same period. Now apply the human capital calculation to Tyler's time investment. At an equivalent wage rate of $36 per hour for a knowledge worker earning $75,000 annually, 60,000 hours represents $2,160,000 in foregone human capital. Compare this figure to Tyler's terminal portfolio value of $511,000. Tyler paid, in time alone, more than 4 times his entire retirement savings for the privilege of finishing last in a 3-person race. The man who worked a second full-time career for 30 years finished with $511,000 and spent $2,160,000 in time to get there. The man who spent 3 weeks finished with $1,778,000. Before closing, there is a structural solution for the viewer who genuinely cannot suppress the activity impulse, and it is important to acknowledge this honestly. The sub 1% of traders who achieve consistent profitability exist. The data confirms it. Confidence is not evidence of membership in that group, but the group exists. For everyone else, and for the genuinely skilled trader who wants to protect their wealth-building function from their trading activity, the Roth IRA provides a specific structural mechanism. Inside a Roth IRA, all gains grow permanently tax-free, converting short-term capital gains from a 22% annual drag to zero. The mathematical value of this conversion, $6,500 per year contributed to a Roth at 10% for 30 years, grows to $116,000. The same contribution in a taxable account subject to annual short-term gains taxation at 22% grows to approximately $83,000. The Roth does not improve the trader's skill. It eliminates the single largest structural disadvantage of their activity, the tax drag mechanism, while capping the downside at the contribution limit. The framework for anyone who wants to maintain the trading activity without compromising the wealth-building function: 95% of investable capital in low-cost index funds. 5% maximum in a Roth-sheltered trading account, sized to lose completely without consequence to the retirement trajectory. Wall it off. Keep it small. Keep it inside the Roth. Protect the 95%. 3 executable steps emerge from this analysis. Step 1. Build the core wealth engine in low-cost broad market index funds, the boring mechanism that compounds to $1,778,000 without requiring 60,000 hours. Step 2. If the trading impulse cannot be suppressed, wall it off at 5% maximum inside a Roth IRA, converting it from a wealth destruction mechanism to a capped, tax-sheltered learning environment. Step 3. Use the correct scoreboard. Measure every trade, every strategy, and every approach against the index return for the identical period, with identical dollar amounts, counting every hour spent as a real economic cost at your actual wage rate. If hundreds of hours of research and execution produce index underperformance after this calculation, that is not a hobby. It is an expensive job you are paying for the privilege of performing. The trap was never trading itself. The trap was mistaking activity for progress in a system that does not pay for effort, and in many documented cases, actively penalizes the behavioral consequences of effort. The 3-week investor beat the second career trader by $1,267,000 across 30 years. Not because markets are random. Not because skill is impossible. Because patience, structurally implemented, is the highest returning strategy available to the documented population of retail investors, and the 15-year record of every single trade executed in an entire nation's market confirms it with a precision that no individual anecdote, no screenshot, and no 2-year winning streak can credibly refute. The withdrawal sequencing errors that erode this advantage even for investors who build the correct foundation, the specific distribution decisions that convert a well-built portfolio into an unnecessary tax event, represent the next layer of this framework. That analysis is mapped and available immediately. The decisions it addresses are being made right now by investors who built everything correctly and are unknowingly dismantling it at the exit.